Good evening, everyone. Welcome to the trade findings and adjustments for Tuesday evening, the 21st of April in 2020. My name is Kevin Hurley. I'm going to spend the next half hour with you going over what I see in the market and suggesting some opportunities that you could have. Plain and simple, let's start out looking in our market. If we were to take a peek at this chart, something should stand out to you that is beyond obvious. So if you were to look at this chart, start telling me some things that are going to be no-brainers for you. Some things as you look at the chart, you're like, hey, you know what? Someone should notice this. Someone should understand this. Someone should pay attention and know that the probabilities say this is going to happen. So if you take a peek, looking at our market, what would you tell me would be your first interest or your first opportunity? Bingo. Mary nailed it right out of the gate. We apparently have a resistance or a 2-day test of the 50-day. So we're heading back down. I'd agree with that 100%. Where's our first support level? Where's our first support level if we are starting to head on down? If you're like, hey, we're starting to head down, you need to have a general idea of what you think, maybe not what you think, but where you think we're going to head to. So where do you think you're going to head to? So interesting. And Mary, a good guess, but to say, and you probably see the 2761. So if you're taking a peek and you're saying, hey, we're looking at one of our more recent lows right here. You could also pick it out right here, right? You've got two recent lows there that without a doubt could be your lows, except for the problem, we're already below 2761. We're at 2736. So I'm going to run over to Lee Maxwell's comment. Your pivot point, your center point, your pivot point, your median right there. We've already gone up almost half of 1 standard deviation to our R1 support level, which our R1 is at the 3083, 200-day at 3010, couldn't break the 2840. So big money is telling you right now, probably going to head back down, right? So I love it. Lee, I agree. Probably your first level on down was 2637, and our second level on down, Lance, you mentioned it, that 2450-ish range. So let me put this question out there. It's about a 6-week question. If I was to ask you guys 6 weeks from now, where are we going to be? Tell me where are we going to be 6 weeks from now? I'm going to do it in a poll question. Here you go. You just had a question pop up. There's 17 of us or so. Where will the S&P be in May 2020? And to let you know, I went the first one, 2200, down to the lows that we had in March. The second one, 22 or 2420-ish. That'll coincide honestly with 2450-ish, our W point, right? I then chose 2750, which is where we're at right now. 2840, our 50-day, or 3010, the 200-day. Where are we going to be? I'm going to give you guys 10 more seconds. So you should have seen a poll that pops up. Click on one of the numbers that you think we're going to be at, and we're looking out 6 weeks out in time. I'm going to give you 5 more seconds. 5, 4, 3, 2, 1. And we're going to close them. And let's go ahead and share them really quickly. Pretty interesting. Half of us, exactly half of us. So out of the 16, 8 of you chose 2750. You basically said 6 weeks from now, we're going to be right here. 33% of you, so that's what another, what's 33% of 16? 5 of you maybe? 5 of you said, hey, we're going to be down to the 24, 20-ish range, which again, pretty simple. We're looking at that low point, right? The hey, we're going to be down at the low point. And then 17% of you, so what? 2 or 3 of you said we're going to go retest the lows. So what I'm seeing, if you asked me, half of you said 6 weeks from now, we're going to be right here, right where we're at. A third of you said we're going to be right down here. And 3 of you, or 17% of you, said we're going to be right here. There was not one person that truly thought we were going to be higher. So out of 17 now in this group, why? Justify where we're going to be. If you asked me 6 weeks from now, I would have went with the 33%. I'm probably going to say we're going to be down here. But that's me expecting us to go down, do a double test, and then we're going to come back up to this point. But if you're thinking about where we're at, why? And Lance, first one to type in, probably going to go down and test the lows, and within 6 weeks, since we bounced back so quickly, we'll be right where we are today. Interesting. Mary, with earnings and the way that people view them, we'll be down at the lows. So we're probably going to retest the lows because of earnings. Anyone else has a comment? David, we hit resistance and failed to break it. So you think for David, we're thinking all the way back down to the, you're one of the 3 at 2,200, David. That's interesting, I can tell. So in all honesty, our expectations are bearish. And I'm going to agree with all of you. And one of the biggest indicators will probably not be shown tomorrow, but we're starting to get this rounding, these crossovers, getting off of the overbought. Pretty soon we're going to cross our 5 and our 20. We have our death cross, so we're looking from an 8% drop from the 2,600 range. I wonder what an 8% drop is off of 2,600. If I was to do the math on that one really quickly, 2,600 times 0.08, 208 points, huh? And that would put us right at that 2420-ish range. That's right, came up with that. So the death cross is telling us that we're going to be down at that 2,400 range. Pretty interesting. As I went through and I started to look at what I wanted to share with you tonight, where things can go, what seems to be important to me, I took a look and I said, hey, pretty interesting. Pretty interesting that we do have a gain of 18% for 1 month, but in the past 3 months, we've lost 17.59%. Year to date, we're down 15.3%. And if you ask this group, in the next 6 weeks, our expectation is we're going to be down lower. Or half of us said we're still going to be down 15%. So I would agree. And my thought process comes down to earnings. This was this morning. Stocks making the biggest move in the pre-markets. I'm going to go ahead and I'm going to copy that. And let me go ahead and put this in here. I'll do the rest here later. Coke reported earnings of 51 cents, beat by 7 cents. Revenue also came in above Wall Street forecasts, but there's no forgiveness for guidance. The company said a shift in consumer habits due to the COVID-19 pandemic would materially impact this quarter. So what they're trying to say is people aren't going to buy their products in the restaurants, and we can't buy enough in the store. If we took a quick peek at how we ended up, Coke today, brutal. Actually, not too brutal. Nice comeback. Only down 2.47%, pretty much in line with the 3% down on the S&P. I guess it was 2.5. But well off of the lows at 44.49. So not bad, and it's up a little bit after hours. Not that that means anything, in all honesty, but down. No forgiveness. Philip Morris, tobacco producer, beat estimates by 8%. Quarterly earnings at 121. Revenue also beat. The company said that COVID had a limited impact during the quarter, but it would hurt full year results. Down 6%, $4.58. It beat top line, it beat bottom line. It had little impact for the quarter, and the dummy opened up his mouth, and they ate it. It was horrible. Lockheed Martin, kind of important if you're worried about airlines. Boeing, defense contractor earned 6.08 per share for this quarter, beating the consensus estimate handily by 28 cents. Revenue also came in above analyst projections. A smart thing to say was that we're going to give no guidance. But instead, the company said it's just beginning to experience the impact of the COVID-19 various businesses, and it'll have an impact in 2020. I mean, common sense, people. Duh. Of course it's going to. You don't necessarily need to tell people that. Lockheed Martin down 2.5%. Came in down $9.77. Again, brutal, absolutely brutal when we're talking at a 3.07% down in the stock market. It beat top and bottom line. They just had to be smart with what they said. Well, let's do Amazon. They got an upgrade, raised the target price to $2,800. Faster growth. Wow. Amazon took a hit of $65, or it lost at 3%. So Amazon does not seem to be able to buck the market trend. IBM, quarterly profit of $1.84. Beating estimates by 4%, but revenue came in below, and they withdrew their annual forecast. Beat on top line, missed on the bottom, down 3%, market average. There are a couple more I wanted to go over with you. General Electric did nothing more than refinance. GE did nothing more than refinance $20 billion and shore up their balance sheet, agreeing to having $15 billion of cash plus what they have on hand, right? only down 0.5% and was up for most of the day. It bucked the market trend because it's cash flow positive and it has a hoard of money stacked up. Darden Restaurants raised $400 million through a share sale in order to shore up its liquidity. Already down 45% this quarter. Up today 2.5%. By really just getting together 400 million. I want to say that's it, because when you compare it to GE, who's hoarding up, they're hoarding $20 billion, a $400 million hoard for Darden Restaurants, who is suffering, I don't want to say tragically, but tragically, gets an update today. Unbelievable. There's one more I wanted to go over with you. Beyond Meat with Starbucks. You can now have a latte and fake meat on a croissant, right? I must say, I do like a bagel with cream cheese and meat on it. It's a German sandwich. Beyond Meat will be selling its product in Starbucks. Nothing set up. Whoa, up 7.4%, another 1.44% after the market hours. So, why am I telling you all this? I'll put all this stuff in here, but when it comes down to it, if you beat top and bottom lines, but mention COVID-19 or slowdown, you are going to tank. Good word. I should say words. Come on. Good words. All you have to say, withdrawing yearly guidance. That's it. That's all you got to say. And you're okay. If you look today, after hours, we might actually have our first up day in a couple. And it's interesting because that up day is only 3.5 points on the S&P, 59 the Dow. It's really only 7.94 on the NASDAQ, I thought. 22.3, excuse me. Very interesting because Netflix killed it. Netflix did amazingly well. At one point, they were up $27 after market hours. 15 million new subscribers. That $27 evaporated to just 57 cents. What else announced today? There was one other one that was up big. Man, for the life of me, I don't remember. What was the one that was up big? Dang it, there was one that was up big. Why am I not remembering it? Not under, Chipotle. Chipotle, CMG. Lyft bit the dust, just like Uber. Chipotle, because they've had 3 weeks of increasing volume at their restaurants, is up 5.89% after hours. It is perception. It comes down to perception, and funds to weather the storm, which means Apple should kill it, right? They're only like the 7th largest country when it comes to cash on hand. Apple should kill it. But there's no way it's going to sell 43 million iPhones in the first quarter. And just putting it out there, common sense tells me that Cook just doesn't have it in him. There's nothing that Cook says that compares to anything that Ivy used to say or Steve Jobs. Cook just doesn't have it in him that will cause the confidence to have Apple go higher. A drop in that first week after earnings is about 10%. So you can figure you'll lose 10%, and then who knows? A good rebound back up. There is no normal right now in what we're doing. But you can beat top and bottom lines, and if you mention COVID-19 or a slowdown, you're going to tank. Good words to use, withdrawing yearly guidance, you can go up. They also like to see funds, stocks that are available for you guys to have funds to weather the storm. Those are the stocks that you're looking for. Some help for you. Something I found today that I found dramatically interesting. If you want to use Pete and John Najarian's weekly options profit and subscribe and get their unusual options activity, on the low end you're at around $29.95 or your $5,000 to get access to their cool proprietary, that's what I'm looking for, algorithm that watches those option movements, right? Those option movements. Well, I also found out today that bar charts for unusual stock options activity that you can kind of get for free sells this for about $389 for 2 years. So you can go spend $5,000 or between $3,000 to $5,000 a year for the Najarian Brothers stuff, or you can get exactly the same thing right here. Now, a little interesting. When I went to the volume, I started to take a look at some things. Bank of America, strangle straddle. More people were bullish just by a bit, and more open interest that wasn't filled. Bank of America has a slightly bullish side between now and the middle of May. Shocking. Who in the hell is doing 3-day option trades on Apple? What does it say? A put option at 260. Most volume right there. A call option, $10 out of the money. Second most volume. All expiring on Friday. 275, call option to the upside, third most volume, and then 270 put to the downside, fourth most. I can't believe, taking a peek at this, 58,000 63,000 call options were placed today for 3 days, and 68,000, excuse me, 63,000 call options were placed today, and 64,000, 65,000-ish put options were placed today for 3 freaking days. I am shocked at how many people are day trading options. With that said, anyone notice what happened with oil today? So look to bar charts for 389,000 package that gives you unusual options activity. All right, something else, oil today. Oil, and who are they? They're one of my extras I have. They are Interactive Brokers. Interactive Brokers for earnings today said, anyone pay attention to it? What did they say? $600 million loss, 88 million that they margin called, and 6 million they are responsible for. Now that for the first time, negative values occurred for commodity trading. Shocking. This is retail, by the way. None of this right here is institutional. That's got to be even more. But retail on the May, the one day yesterday, right? I believe it was yesterday. $600 million in losses. Out of that, 88 million wiped out retail traders. Margin called, zeroed out their accounts. And out of 88 million, 6 million the brokerage is going to have to cover because there was no more money in the account by the time what do you call it, stop losses kicked in and everything. There were negative values left in accounts to the tune of $6 million that you're going to see Interactive Brokers have to bite the bullet and eat that one. It was funny because he says, well, it doesn't happen often, but that's because we have sophisticated traders that are retail traders. He stayed away from the verbiage high net worth. But basically in one day, $600 million loss for retail traders. 88 million that were margin called, so $88 million worth of accounts were wiped out. And in that 88 million, 6 million, because the system didn't work that enough, 6 million Interactive Brokers is going to be responsible for. So people ask why I don't trade pips, and I'm trying to get, currency swaps or trading currency or commodities. For me, I think 88 million is a huge number for retail. I think $600 million on a loss on one single trade is a huge number for retail. I think 6 million that the brokerage firm is going to be accounted for because the stop loss is triggered in a way that created $6 million of negative account value balances. I think it serves those sons of bitches right. E-minis, futures, commodities, currency holds a ridiculous leveraging to risk that makes options look childish, petty. One contract covers, 100 shares, and a short has unlimited risk. Ooh, you can raise that 6-1 playing commodities. You had an 88% drop. When have you ever traded a stock or an option that lost 88% in a day? Not saying it can't happen, but this was horrific. So, a help for you, please stay away from futures trading, commodities, currencies, swaps. It's just, oh my gosh, it's life-changing to the bad side. So with that said, last but not least, ideas. I'm going to apologize. It's a small account. So let me just make this comment. Kind of nice today in the trust account. Holy crap, I'm getting my butt handed to me, but I was actually up for a day. Yes, up for a day in Baidu. Again, we made the comment for $3.40. You could get into a Baidu call, and there are a couple ones that we mentioned. This particular one is upside down. It's the January 155s. So I think it was the January 150s that you could have already gotten out for about $1.40. But going out in time, if you want to be cheap, the January 21 155 calls are nice. I would be going farther out to a January 22. But if they could be dishonest about their numbers, their cases, the people that are killed, being killed, so to speak, they can be dishonest to your benefit if you wanted to trade them. Baidu seems to be ahead of us. So whether you go for dirt cheap, somewhere in the 150 for 229 or for 155 for 216, a pretty big opportunity here on Baidu. If you want to go for some bigger returns longer term, go out to January 22 and be cheap there too. Go out to 175, 170. In fact, actually look at the 165s. You want to see screwed up option pricing? If you were going to look at the 150 down to the 185s, there's a glaring option that stands out to you that you should be purchasing right now. Glaring. Screaming at you. January 22, 165s for $5.61. No brainer. No brainer. You're looking for a new trade, I would start right there. I would work my way down. I would be cheap. If you can do 10 contracts, start off with 2, start off with 3. If you're looking to January 22, 640 days, even if it goes up, you can add more contracts. You can dollar cost average on the way down. You can dollar cost average on the way up. It's a glaring, easy one to see. With that said, I also, because we're all thinking things are going to be heading down, right? Even though I was up today in my Disney calls, I was up today in my Under Armour calls, I would also be looking at some type of 4 to 6 weeks out. I'd probably go 6 weeks out in all honesty. I would look to play, I'd look to play your index of choice. If it was me, I can only afford the SPYs. That would be my index of choice. I wouldn't get ridiculous. I would most likely be looking at, I believe it's a May 27th. Let's see what I'd be looking at. I don't know what I'd be looking at. May 29th. I would take the May 29th. But where we're at, where we think we're going, we'll probably get an update tomorrow. In all honesty, it's a pretty easy one for me. I would choose net the money. It's probably going to be at that 275. If I could do 10 contracts, I'd probably start off with 2. They are still ridiculously expensive. But doing the math right, maybe going down to that 24 range. You can do a $35 spread right now and do it for $9.73. A $35 spread, playing where we're at in that resistance up there down to 240. You want to be a little more going for it, right? You want to take a quick look and say, hey, maybe it is going to hold 2,500, right? So pick 25 or 250, excuse me. Make it a little bit cheaper. A $7.73 spread to make 25. If you really think it's going to go all the way down to 2,200 again, play your belief. Go down to 220. A $55 spread for $12.37. 6 weeks out in time, you're really playing the next 4 weeks because you want to be out of this before the last 2 weeks of options expiration, and time decay really kills you. I like it also because, in all honesty, if we see things going or heading back down, your VIX sitting at 45.41, we know it can get up to 88, right? We can know up at the close and get up to 83. What an awesome opportunity to be in this position. And your thought process or your game plan, right? If for some reason we are wrong and technology comes in and reverses our trend, well, as soon as it gets above 28.40, you can create a bull put and roll it up to, 280, and you're going to go from a bear put that was 275 to 240, 250 roll that short up to 280 for a profit, and now you're in a bull put. And of course, from 280 up to 30.10, when you get up to that 200 day, you pull it off for your profit and you're done. It's kind of a no-brainer. So those are a couple trades I'd suggest you look at. With that said, please comment on this oil crashing and a canary in the coal mine. So crude has always been a precursor to expansion, meaning if you're expanding, you're going to use more energy in your factories, you're going to do more transportation, you're going to have more demand from people that are making more money, that are spending it, more airline travels. It's the whole thought process that if crude is at a higher price, it means your economy is kicking on all cylinders. That is not necessarily true. That is the demand side of it. And right now, people have completely considered that the demand side is all that matters. I call BS. As someone just typed in fact, that was Bill, there are Saudi tankers parked offshore. There's actually one of their major super tankers coming over to the United States with 50 million barrels of crude that apparently we've already purchased, that we've got nowhere to put it. Now, I don't know if it's true we have nowhere to put it, but the short answer is this is not necessarily a demand, even though I'll be honest with you, without taking kids to school, to karate, to soccer, to gymnastics, to friends' houses to play, without my son out dating his girlfriend and every other girl in the freaking school, man, we've chopped our gas down to like 25% of what we normally spend. We're normally spending, really, we're doing 4 to 5 gallons that, every 2 weeks that we're down to a gallon, or one, excuse me. We're doing 4 to 5 fill-ups every 2 weeks per car, and we're down to, as parents, down to 1 fill-up in that 2-week period, maybe 2 for me because I'm out a little bit more. But it's cheap. And I don't think you can say right now that oil crashing is a canary in the coal mine, because it's also a supply. We're oversupplied. For the first time, OPEC doesn't run the price of oil. It's run by the United States, Venezuela, Brazil, Mexico, Canada, Russia. There are producers that are flooding the market. This is the only way that Russia is paying off its debt right now. So this is not a demand. It does not, although it can be, or it has been as the economies have slowed down, it'll pick right back up again, but this is a supply issue. This is why OPEC was requested to cut. This is why you saw the little, pissed off match between Russia and OPEC, Saudi Arabia and Russia. I mean, it's really a supply issue. And it's not related to demand or world growth at this point in time. Not that it's not, but usually higher prices because demand's there because economies are skyrocketing. That hasn't happened the last year and a half. Ever since the United States became a net exporter, our economy was doing great before this. And oil was falling down from that point as well. I mean, we've had oil down low. So the short answer is I'm not buying the canary in the coal mine. In fact, if anything, for any consumer-driven economy, lower oil prices usually means higher GDP because consumers are out buying crap. I'm not going to get a stimulus check, but I probably have saved between $600 to $700 in gas this month. I do that a couple more months, and I'm going to go buy another 50 caliber rifle. Good question, though. Any other questions I can answer for you guys? With that said, glad to have you here today. Thank you for showing up. Have a good Wednesday. Keeve and I will see you on Thursday morning at 10 a.m. Mountain Standard Time. Guys, be safe out there. For those of you that are those first responders, first liners, thank you so much for having the jobs that you have. But take some extra care if you can to be safe. I'll look forward to seeing you guys on Thursday. Looks like we'll have an update tomorrow. We'll get a bit of a rebound. But I think overall, like you said, we're probably heading back down. That 50-day simple moving average is the line that we've had 2 times to break it. We're unable to do it, which usually dictates some downward movement. It wouldn't surprise me if we're up against it tomorrow, but that means if we're up against it tomorrow and we have a nice big update tomorrow of 70 points, roll your puts up. Roll your puts up. Your probability is we're going to hit that 50-day and come back down. And as we just said, everyone in this group, all 16, 17 of you, plus myself, 100% of us think the market's heading down in the next 6 weeks. Adjust your portfolios accordingly. Have a good evening. Look forward to seeing you on Monday. Good night, everyone.